Is up, everybody? We are asking the question that everyone's asking. Is it time to buy the dip, or do we got to wait a little bit longer for the market to fall? That is the big question out there. Let's go ahead, roll that intro, and we'll talk about, is it time to buy the dip?
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Meta Hammond on the show to talk some IPOs. Jake Wujasek from Trend Spider. We have a
breaking news. All right, guys. I mean, here's the bottom line. Yesterday was one of the biggest bloodbaths that I've seen since the couple years, 3 years I've been in investing in the markets. The S&P 500 finished down about 3.8%, with, I believe, if not every single stock in the S&P 500 finishing the red, then pretty damn close. Here's the bottom line. We've been getting asked a lot of our audience, is it time for me to buy the dip? Should I go out there and buy the dip? We say this all the time. You don't want to buy stocks that are in downtrends. The trend is your friend, right? It's just like in real life, in physics. You have inertia. Things that are in motion tend to stay in motion. Things that are going down tend to keep going down until that trend is reversed, until we get some evidence that that's not the case anymore and that a new trend is being established. And when we're talking about the overall markets, I don't see it any differently. It's easy to see the S&P 500 down here and saying, oh, I'm going to buy it. It's down 20%. But the trend is still there. It's still showing weakness. Until then, to me, it's not time to fully come in and say with conviction that, okay, I'm buying down here. Now it's time to buy the dip until we get that bottom, until we're coming back up. And I don't want to just see, a couple green days. I want to see like 2 weekly candles close green on the S&P. And then I'll say, okay, maybe this is a sign, so bottom line is it's attractive out there to buy these things on a dip. Now, if you want to talk about, like for me, for example, I've been buying the dip kind of in a way. I mean, every time I get paid, part of my paycheck goes out into the Roth or the 401k or whatever, and it gets invested into some BlackRock ETF. That's fine. If you're buying the dip that way, where you're just doing your normal, bi-weekly or monthly contributions, and you're, years and years and years and years away from retirement, then yeah, of course, keep accumulating. It's never time, in my opinion. That's always a good idea to kind of just buy and hold for the long term for your retirement account. But with that said, if you're talking, strictly about trading and investing, too many people have gotten burned trying to time the market, to time the bottom, to catch a bottom, and to say, oh, it's down 20%, Apple's down 25%. How much further can we really go? Well, you're about to find out. We're about to find out, because I don't know. I don't have those answers for you. I don't know how far Apple can go down. I know, looking at the chart, it looks like we're still in a downtrend, and we got a few more, we got a few more bucks to fall. And that's why, you have Warren Buffett's thing where he's like, timing the market isn't important. Time in the market is important. If you have time on your side, if you're like me, you're in your 20s, you're in your 30s, and you're years and years and way to retire, you can keep accumulating down here. You can keep adding. I just wouldn't, even if you are young, if you had $10,000 to invest right now, I wouldn't tell you to go out and put all 10,000 of that into the S&P 500 right now. No, I'd say, well, let's wait a little bit. Or if you really are dying to put some of that money to use, let's put a chunk of it in now. And then if we go lower, we can add more as we go lower. So those are my thoughts just on the overall buy the dip. I mean, it's again, attractive to want to do so. But historically speaking, when we're in a downtrend, we're in a downtrend, and it may not be. We may have to look back on it in 2 weeks and say, okay, I guess that was the bottom, or whenever that happens, we might not know in real time that this is the bottom. So just be careful out there. Don't take on any more risk right now than you can handle. I've been seeing a lot of horror stories of people essentially, getting to that point where they're getting margin called, they aren't able to pay loans or something right now. So really now is a time to assess your risk, to look at where you're taking risk, and determine that if that's a good, risk reward ratio. But all right, I see my man DG David Green hanging out in the background. If you're new with us today, David Green has years and years and years of Wall Street experience. He was a NYSE New York Stock Exchange trader for a while. He joins us every Tuesday to run through his charts, see what he's looking at. David also runs his own room and then also a trading course with Peter Tuchman, who you might know as the Einstein of Wall Street. So excited to get David on. Let's go ahead and give him one of our special intros, bring him on, and see what he's been watching today. Mr. Green.
There he is. I have to say, Aaron, that everything you talked about and the way you said it was really, really excellent. Right on the button.
Well, I appreciate it. That means a lot coming from you.
No, perfect. I mean, as far as long-term stuff, and if you're younger, I mean, that's exactly what you want to be doing. Keep contributing. It's going to be fine. It's always going to be fine. It always ends up fine. I've been saying for weeks that I think it'll take a little longer this time to get back to where we were. There's just a lot of stuff still going on that is still unsettled, and that's probably going to be for a long time. But
yeah, and I think that's one of the things right now is that we've gotten used to such a quick market that people want to see us back at new all-time highs in a month and make up this 20%. It's not going to happen. We're not going to get that same V-shaped recovery that we got during COVID. So it might look a little bit different, but bottom line, the S&P 500 has drawn down 20% before, and it's made new all-time highs after that every single time. So, I think it's just important to have that perspective and know that, hey, it's okay that if the markets aren't going to rebound as quickly as we did last time.
Correct. And another great point you made, as a new investor, you don't shoot all your bullets on the first shot. You slowly go into the things that you like. I recommend, 25%, 25%, 25%, 25%. You get into 100% of whatever it is you're looking at as it goes down. And then you just, you don't look for a couple of years. Look, the best advice I can give everybody right now is not to look now. I mean, that's the best advice I can give you if you're in the market for long term. But we got to talk technicals, right? And I'm just a very technical guy. We haven't been in the markets for a long time. So let's look at where we are in the SPYs. And another thing that you mentioned, that, guys, we're not going to know when the bottom is here. I can tell you that right now, okay? You'll look back a week or two out and say, oh, that was the bottom, right?
Right.
Nobody's going to know when the bottom is here, okay?
It's the same thing when it's a top in the market, right? You all of a sudden you're down a couple days and you're buying, you're like, oh, we're in an uptrend. And then 2 weeks later, you're looking back, oh, no, shoot, maybe that was the top and I was buying up there.
Exactly right. That's exactly right. The one good trade that set up for us today is we kind of tested yesterday's lows again, right? If we look at yesterday's low, the low was 373.30 in the spiders. This is yesterday, okay? And if you look at our 5-minute chart, today, we just about got to the exact same spot and got a $2 bounce off that. Technically, that's beautiful. That's what we call a double bottom, right? So we bounced off that level, which I guess is a little constructive, considering that we did bounce off that level. We didn't, break right through that yesterday's low and then continue going down. So that's a little positive, right? So, the one thing we can hang our hat on right now is, 373 might be a little level that we held for a little bit. But, if we go daily, and again, I'm doing this 35 years, Aaron. I mean, this is crazy to me. When you see the spiders in 4 days, right? I mean, we went down 10% in 4 days, something like that. Yeah, about 8-9% in 4 days. And I look at my relative strength in the SPYs, and very rarely do you see this on a daily chart, get to a 32 RSI. So there's no question in my mind that we're extremely oversold in a lot of things, okay? But that doesn't mean that it's the bottom. And one thing that I'll tell everybody out there is that the market can keep going in one direction longer than we can stay liquid if we're not doing the right things, okay? That is for sure. So anyone who's out there who says this can't go any lower, well, if you haven't learned your lesson by now in some of these stocks, that we've looked at and we could list 100 of them: ZM, Doku, Affirm, whatever. There's a million.
Peloton.
Stocks can keep going lower. That's the bottom line, okay? And longer than you can stay solvent. I can't see the chat, Aaron, if you can pop that up there so we can.
Oh, yeah. Let me make sure we've got the right settings
So,
on and whatnot.
So here's what I'm looking at, guys, in the spiders, okay? And I'm going technicals. And we got to go out to a weekly chart. Okay. I have a major support level. Now, when I have something on a weekly chart that's going to hit my 200 EMA, that's huge. And that level, guys, is 363 bucks. Now, as I said, I've been out of the market for a long time. I am going to start to pick at a bunch of stuff if we get to this 363 level in the spiders, which, by the way, we can do in 10 minutes. You know, it doesn't mean that that's going to be the bottom or even close to it. But my feeling is down 20, 25, 30%. I think for longer term investing, it's a good place to start. Okay. And again, that doesn't mean you throw all your bullets in one shot. It certainly does not mean it can't go lower. And then I'm going to show you my monthly chart. And the next level I have is 336. All right. So the two levels I'm looking at are 363 and 336. And it doesn't mean we're going to stop there. But at 336, we're down almost 30%. And again, I think that's a good spot to start picking some up and adding to what I'm going to do starting at 363. That'll be a point where I'll probably just hang out. I mean, our monthly level below that is 235.
Yeah,
if we get to the monthly level of 235, we got a lot more things to worry about than our portfolios and everything else. That's a 50% retracement. I don't think we're going to see that. But those are kind of a couple levels that I'm looking at. You guys know the stocks that I like. I'm going to be looking at Apple. I'm going to be looking at NVIDIA. I'm going to be looking at Amazon. I'm going to be looking at Microsoft. All real companies that make money that aren't going anywhere. It's not going to be the Dokus and the Rivians and the Affirms that I'm going to start looking at, no matter how cheap they get. So that's a little overview of what I'm looking at. You know, the market's been tough to trade lately. It has not been an easy market to trade. And it's because we're so volatile. I mean, just, you know, in 5-10 minutes now in the spiders, we're having these moves that used to take 5 days to happen, right? It's crazy. So you got to be a little careful as far as the trading is concerned. Really be patient, really be disciplined, and pick your spots as far as, you know, the short-term stuff is concerned. And it's still fine. It's still working. Nothing has changed as far as that is concerned. I know I'm going on and on and on here, but that's the kind of market that we're in. And I think the best point you made is if you're young, you keep putting into this market. Don't even worry about it. You're going to be fine.
Yeah, and that's where, I mean, right now it's like I feel you know, almost bad in the sense that, like, I'm not worried at all because I know, like, I'm in my accumulation phase. In fact, you know, being able to add to some of these positions at lower prices is almost good for me. But people that, you know, are maybe a little bit older, close to retirement, who maybe they have like a 60-40 portfolio, mostly in bonds, but they're still looking at their portfolio, seeing it down 20% in the last year. And they're saying, oh my God, like, am I going to be able to retire now? So I try to keep that in mind because I know I'm in a very lucky, like, blessed position to be able to say that, to be able to say, oh, I'm not worried about this. I'm just going to keep adding and I'll be fine long term. I'm not going to even open my portfolios for, you know, withdrawals or anything for another 30 years anyway. So I don't care, but not everyone's in that position.
No. And in the environment we're in now, you know, for older people who are, not only are they watching their portfolios go down 10, 15, 20%, it's going to put off their retirement. And it's getting so much more expensive to live, guys and girls. I mean, I went and filled up my car the other day. It was $44 3 months ago. It's $66 now. I mean, that's huge. You know, you're talking about 30% more. And tomorrow's going to be a big day as far as raising interest rates again. They got to get this stuff under control, and it does not happen overnight. Not when we were in situations like this before. It just doesn't. It's going to take a little longer to get this stuff straightened out. I think as far as tomorrow is concerned, I think everybody's kind of priced in a 75-point raise now. It was 50, but I think I don't think anyone's going to be shocked if they do 75 tomorrow, and then 75 at the next meeting. So we'll see what happens. I'm kind of the school of thought, and again, I could be wrong, and I don't give financial advice. A lot of tomorrow's news has to be baked into this market already.
100%. I think so too. You would assume so. And David, you should be able to see comments now. If you still can't,
I got it.
Just give it. You got it. Perfect.
Yeah, Lisa, some are down over 50% if you've been very aggressive. No question about it. You know, and look, that's a story to have with your financial advisor, depending on your age and your situation and what you need to live. My thinking is if they really do something stupid on a downside tomorrow, after they make this announcement, I will be a buyer of a lot of stuff for at least a trade for the rest of the week, because we are extremely, extremely oversold and should get a bounce back here. Oil, someone just mentioned the ECL. Yeah, oil's trading down a little bit as
at least for natural gas. I know we had a.
Oh my God, we were involved in that today.
I'm seeing someone else in the chat brought up FedEx. So FedEx actually, I don't know what the stock's trading at now. It was up 13%. Yeah, up about 14% from when I looked at it. So they announced they're increasing their dividend, increasing some guidance as well or something. And here's what's so confusing, David, is it's not like everything we're getting is super bearish. Like you're seeing FedEx put out this good news, and what does FedEx do? They're shipping us all our goods. That means that goods are going through the system. That means people are buying, companies are buying goods. That means people are getting things delivered to their house. Like FedEx doing well is a sign for the whole overall economy. Yet, you know, all the good headlines are getting buried, and all the bad headlines seem to be the ones that are moving the market here.
Yeah, no question about it. But I have a couple of cynics in my room that are they giving you all this now because the earnings aren't going to be as good when they actually release them. So
maybe, but I think typically companies raising dividends are signs of strength. But I hear that too, that they could say, oh, okay, we're going to lose some. We're you know, people aren't going to want our stock as much when we put out our next earnings report. What can we do? Oh, well, we can you know, raise our dividends. So I don't know. I could see it either way, but I think typically companies raising their dividends are signs that they're doing well.
It should be, and I don't think they're going to sandbag anybody. I really don't. Just hold on one sec. Okay, guys, if you did the double top in the video, that 159, what was it, guys? 159.10. Yeah, okay. So we just had a nice double top trade set up in the video around 159.10, and Alex, you got 50 cents, looking to get $1 out of the balance of it. It's a little trade that just set up for us in the video. We did a double top, and it's worked for 50, 60 cents so far. Nice job, Alex, by the way. Yeah, we had a halt in UNG today. It all has to do with one of the refineries, right, guys? One of the refineries.
Yeah, there was an explosion at Freeport down in Houston. They said a full restart won't come until late 2022.
Right, a few months. So we bought a little bit of this down in this area down here, and I think we got out. We did a far from moving average trade down here, and I think we ended up making a couple of bucks on it. But then we stayed away from it from then on. So I guess you got to just avoid that for now until they come back with something where it's getting closer to opening. Revlon, yeah, not something we trade. Dollar stock. It had a nice move today, though. It actually went up 100% at one point.
Wait, I really don't understand, and this might be stupid. And David, I'm sorry to pose this question because it's not really related to charts or day trading.
It's okay.
But if the natural gas refinery goes down and demand for natural gas stays the same, but supply is limited, wouldn't that make the price of natural gas go up? Why is it going down?
Exactly what the people in my room were saying. Yeah, 100%. I mean, if there's less of it, how could the price go down?
Right. They're like just a simple supply and demand, like basic econ. If there's 100 apples out there and the demand for apples, people are willing to pay $1, and now all of a sudden there's 50, that would make the price of apples go up, not down. I have no clue. Okay.
Which is exactly another reason why technical analysis is so important, because all the way when we were watching this go down, there was no spot for us to buy it. So, and if you got into that thinking, right, and you're watching this thing get absolutely destroyed, you're going to lose a lot of money in this thing. Wait a minute, why is this going down? It should be going up. Well, guess what?
Yeah, this is why trying to bring like rational thinking into the markets doesn't often work, because it doesn't.
Yeah, well, that's why, as far as just trading is concerned, it's all technicals. And I don't care about the news or anything else. I look at the stock. I look at the technicals. If it's setting up for us to do something, we'll take a look at it and we'll do it. That's it. Don't get involved in any of that other stuff. Boeing, guys. Yeah, again, guys, Boeing just hit the pivot point. I don't know why. Look at this, guys. Anyone see anything in Boeing? But look how nice this was. Boeing in the last 10 minutes, guys, went from 115 to 118.50, up $3.50. Did the market move up like that? No.
I don't know. I'm seeing a crazy move. Let me check my Benzinga Pro, see if we're getting any news headlines in here.
Well,
David,
here's the thing. It just gave us a trade up at the pivot point at 118.50 and pulled in for almost 70 cents. Again, technicals work nicely. See if you can see anything. It probably came out. I don't know.
No, we just got a headline saying that there's higher than average volume, but no like company specific news. It doesn't look like. I'll keep looking and seeing if we got anything. But David, we do only have a few minutes left.
$3.50.
Wow. We do only have a few minutes left, so I want to make sure you get time to talk about your room and.
Don't worry about that.
All right. I know you're doing.
We're in our boot camp this week. For those of you who don't know, I do a boot camp once a month. We're teaching the course live, so I can't invite anybody in for this week. But when we come back next week, we'll invite everybody in to come and hang out with us for a week again. And WallStreetGlobalTradingAcademy.com if anyone wants to purchase our course. All good. Let's get to a couple more questions if we have a minute. If anybody has any questions about anything.
Yeah, we got about three minutes till noon. So if you guys got any questions. Got any questions for David or any stocks you want to look at? Speak now or forever hold your peace.
Someone just mentioned Labu. Again, this is the biotech ETF. And probably not horrible owning a little bit down here, but usually what happens with these things, guys, is you're going to get a reverse split at some point. Right? It's going to do a reverse split 10 or 20 to 1. These things are always shorts. All these inverse ETFs are always shorts. This will reverse split again, and then it'll end up going back down to $4 again. So never own these things for long term, guys. That's a recipe for disaster. Ever, ever, ever. Okay.
Adam just asked in the chat, when does Redbox RDBX nosedive? I don't know what chart you're looking at, Adam, but I'm seeing it down 32% today. That's a nosedive to me.
And this is another example, guys and girls, of please don't get caught in the hype and the FOMO. Look what this thing did yesterday. I was talking about this morning. This thing went to $17, $18 yesterday. $18. And on one of the biggest volume days it's ever had. And here we are again back at $10. Yeah, this thing's getting absolutely bagel schmeared. So I'd probably take a shot in this if it got back down in the $7 or $6 range again. And, maybe you get another one of these big bops up. But there's another one that busted a lot of people's trading account overnight. It was 18 last night. Crazy. Don't get caught in any of this stuff, guys. Please, ever. All right, quick Bitcoin before we get out of here.
Yeah, that's a good one to hit real quick.
This is a good one to end on. All right, so we had a level. You can see my mark in there. It's still in there, right around 18 grand. And I'll show you where I'm getting that from. I think it's my monthly level. I'll show you real quick. Yeah, on a daily chart, around 18 grand is our level in Bitcoin. And again, this has just been a horrible, horrible chart. There's people talking about 9 grand now, and I don't know. 18 grand, I'm going to start looking to buy a little bit, and I'll buy it through BITO. That is what I'm starting to look at. This thing has gone down from $40 to $13. This is the ETF for Bitcoin. So if Bitcoin gets around 19 grand, I'm going to start looking to buy a little bit of Bitcoin down there. When Bitcoin was 63,000, it was going to $1 million, and now that it's 20,000, it's going to 0. So the truth probably lies somewhere in between. Isn't that
funny how it works? It's always the change in price changes the sentiment, and not the other way around.
Yeah, and the thing is, when it was at its highs, you have nothing but people saying it's going higher, and now that it's down here, you have nothing but people saying it's going lower. So. Like I said, the truth lies somewhere in between, which just goes to show you guys, I'll leave you with this, even on long-term investments, unless you're 20 years old, like most of you people out there, it's prudent to trim some profits at times, okay? It just is, so that when things like this happen, you got some room to buy some stuff back.
Yeah. No. Well, yeah. I mean, if you're you're saying even in a retirement account, or just if you have an active account you're managing?
No, even in your retirement account, it's okay to, take some profits sometimes when things get what we perceive to be ridiculously overpriced. I mean, look, you guys know I've been in Apple for a long, long time. I've taken profits many, many times on the way up. And now these are the times where I'm looking to replace some of the stuff that I sold at what I consider is a nice discount. So even in the long-term stuff, it's okay every once in a while. And you don't sell your whole portfolio. Look, sell 10%, sell 15%. It's okay to take profits every once in a while, even in your long-term stuff.
Yeah, no, I completely agree. I mean, in my long-term retirement accounts, I'm more just buying and holding forever. But looking back on hindsight, when we clearly got overextended, like in the S&P and the overall markets, I wish I would have trimmed some. But
Well,
maybe
that's the whole
not.
thing. Yeah, exactly. When you had a chance to sell stocks 30, 40, 50% higher, why not take a little bit off the table? That's all.
Exactly. I mean, I think I was up I added Ford in my Roth IRA when it was at like $8. I was up like 200% on it at one point. I checked it the other day. I'm up 20% on it after I was up 200% on it. And I was like, well, shoot, like that doesn't do me any good being up 200% on it a year ago because I'm not
That's
up
right.
200% on it anymore.
Right. So what if you took a little profit off of 200% and now you buy some more back down here?
Exactly. So now I know for next time. I appreciate it.
There you go. All right,
All right,
guys.
David. Always great to have you on. We'll talk to you next week.
See you guys next week.
All right, y'all. That was David Green going to go ahead and drop his links in the chat. We're going to keep it ticking today. We've got a busy day. I mean, the markets are moving, and so are we. We had David Green on. We're going to bring on Shawn, Cruz, the head of trading strategy at TD Ameritrade, in a couple minutes. After that, we will have Christian Fromhertz join us from Tribeca Trade Group. And then at 12:45, we will have Dave Mazza on from Direxion to talk some ETFs. So packed show today. I have some things that I hope we have time to get to, but let's keep it ticking. I see Shawn hanging out backstage. Let's give him one of our special intros and bring Shawn on the show. Mr. Cruz, how you doing today?
I'm all right. How about you?
Pretty good. I'm trying to just keep things positive in this market, keep things, it's tough out there. I think for a lot of people who got into investing during COVID, this is maybe the first real big, we've had a couple kind of drawdowns since then, but this might be the first big one where it's really scaring some people off. But other than that, we're all good. How are you doing?
Yeah, it's definitely been an interesting couple of days. I was interested to see how things would open up to start the week after some of the news we got on Friday, and it looked like there was still some more some serious repositioning going on to start the week. So whenever you have the kind of repositioning that you're seeing with such a sea change in expectations for, a lot of things, particularly around the interest rate complex, it's going to drive a significant amount of volatility in the market. And unfortunately, that the repricing of, or the change in expectations was in a direction that wasn't good for equities. So I think markets are now going to have to do a little bit of a bottoming process to maybe find a new bottom here. But I don't think we're going to get any major clarity on that until the end of the week. Once again, with the Fed meeting, that could change things. Then you might have another day or two of the market bouncing around after that. So for shorter term traders, there could be some opportunity in that volatility. And perhaps if there's some names on your list, you might get a little bit of a pullback. If you have some capital to deploy, you might get an opportunity to maybe pick up some of those names you've been watching.
Yeah, this is crazy. So this is the CME Fed Watch tool. It's essentially just giving a probability of the next rate hike. I was checking this yesterday. So yesterday on June 13th, it gave us a 65% chance of getting another, 50 beeps rate hike. And today that's flipped and is now 97% that we're getting 75 points. And I think there was some news yesterday that came out like after close or maybe in the afternoon, just that someone with inside info or something had said that it's pretty certain that we're going to see 75 points. But to your point, it seems like at this point, a lot of this would be priced in, that like if we get confirmation that it's going to be 75 basis points, aren't a lot of people already expecting that?
Yeah, and I actually think the risk now to the market is if the Fed comes out and only does 50, I think that could actually spur another round of volatility to the downside out of markets. Because I think right now the expectation is inflation is one still getting higher, so we haven't really seen that top yet. That's the first thing we figured out Friday at CPI. Inflation is not topped out yet. The second thing we figured out on Friday was it's starting to really impact the psyche of the consumer with what we heard in the consumer sentiment report, particularly when you looked at that inflation expectation component of the report that came out. The big thing to me was it went for just sort of the longer run going forward. Once we get through all this, they have the longer run expectations of inflations went from 3% to 3.3. So that means consumers are now expecting inflation to be significantly more entrenched. And you fast forward to Monday, the New York Fed puts out its own inflation expectation metrics. That ticked higher as well. So you really had 1, 2, 3, sort of like a hat trick of just bad news on the inflation and what that means for the economy. So I think that's when the market realized the Fed really needs to start hiking to start maybe trying to slow some of this down to the extent the variables that are driving inflation higher are under their control. Two of them, the big ones, Russia, Ukraine, and whatever China does with lockdowns are completely out of their control. But the market wanted to see that. I think they started pricing that in yesterday because this is based off futures contracts and how they're trading. So I think what you saw yesterday was that massive repricing for inflation expectations to 75 basis points. And now I think that's where we're going to be sitting at as we go into this Fed meeting.
Yeah, and I mean, again, just looking at this tool from CME, I mean, a week ago gave us a 96% chance of seeing a half point raise, and then now again we flipped, and now we're 97% going to see that 75 basis point hike. Which, again, this is just essentially probabilities, but it's been pretty accurate in the past, so I can say with pretty strong certainty, at least from my perspective, that we are going to see that announcement for 75. And it sounds like from what you're saying that may not be such a bad thing. I mean, it may, conventional wisdom may tell us, oh, lower rate hike better for equities, but in this environment, maybe investors really do want to see this 75 point rate hike.
I think so. And I think all the other thing that really shift was, okay, we do feel like as hard as it for us to admit, we want the Fed to tighten at a more aggressive pace. That was the first thing. And the acknowledgement is that is going to have some implications for the overall economy. But if you think about it, inflation being out of control at elevated levels, especially when unexpected inflation is the real problem. Unexpected inflation coming in at the levels that it is at is going to make it very difficult for anyone really to make any sort of a decision about what they're going to do with their money. Really beyond a week or a couple of weeks, that can really hamstring an economy. So I think they're saying we'd rather take a general slowdown from a Fed that's aggressively tightening than just everyone is too afraid to do anything whatsoever. That to me is really the big change out of the market. But we are starting to see some recession likelihood really getting priced in. There's actually some rate cuts being priced in next year, which is almost the market saying we do think the Fed's going to tighten aggressively, and it probably is going to put us in a place where we get some sort of a recession to some degree or another, which is going to require them to maybe cut rates a little bit. But that's what the Fed wants to do, is get rates high enough so they have some room to cut if they need to.
Yeah, no, I definitely think that, we're seeing, it's just weird because at the end of the day, like, a recession, as far as in the outside of the equities market, like, it doesn't seem like it's being priced in the bonds market. It's like bonds aren't doing particularly well, and you would expect that if everyone is worried about inflation, would be rushing to these bonds, and they would be doing well. And then you have some other indicators like Forex showing that like the US dollar is just becoming more and more strong against other foreign currencies. And in the past, when it's looked like the US is heading to a recession, the US dollar is actually weakened. So it's just very, to me, confusing getting a lot of these signals where it's like this is pointing to an 100% recession, and then you get some of these other metrics that are like, maybe not. Like I was mentioning today or earlier when my previous guest was on, like FedEx had some great news coming out today. FedEx you can look at as a proxy for the overall economy. FedEx is shipping the goods that not only we as individuals are buying, but companies are buying too. So if FedEx is doing a lot of business, that means that a lot of business is just happening in the economy. And so if FedEx, starts struggling and Walmart starts laying people off, that's what I'm going to be more concerned about. Like, okay, this is an actual recession, and not just some of these high growth tech stocks, whether you're talking Carvana, crypto.com, or like some of these other companies laying people off. It's like, yeah, some of this high growth tech stuff got overextended. So I don't know if you have any thoughts there just about like why maybe some markets would be pricing in a recession and others aren't.
Yeah, I mean, I think one is, you have to consider just the pool of risk capital that's out there. And, me or you putting money in our retirement account isn't necessarily risk capital, but people going out there and finding these companies that may or may not end up being profitable, successful in the long run, that is where you see risk capital going. So it makes sense the frothier areas of the tech market, as the pool of risk capital is now shrinking, capital becomes more expensive. People are going to be a little bit more conservative with it. So as that pool of risk capital starts to shrink, it is going to affect some of those names. But another name that reported earnings, you talk about FedEx and certainly the transports. That's why we care about the Dow transports so much. How are those companies doing? That is a sign of just underlying economic activity, moving goods around. But Oracle came out, had a very good earnings report. And to me, what my read through on the Oracle earnings report was that businesses are still continuing to invest, but they're investing in their digital and technology infrastructure. And that is really Oracle's wheelhouse. So the new business investment isn't property, plant, equipment, building a new factory, whatever that might be, buying new machinery. Right now, it doesn't matter what industry you're in, there's sort of this really big shift. And it's not just the big companies anymore. You're starting to see it drip down into the medium-sized businesses as well, are really making a big push to upgrade their business infrastructure from a technological standpoint. And that can be good for companies like Oracle. And then a lot of the infrastructure companies, NetApp was another one that got a little bit of an upgrade today too. So I think those themes are something that, might be rocky here with the overall market to begin with. But, in the long run, those can be companies that are going to be positioned to have pretty strong growth moving forward. I mean, NetApp's doing well. Oracle is actually expecting their cloud division to grow over 30%, for the next year. 30% growth is good. They're trading at a little bit of a discount from a multiple standpoint. So you can look at those names and see if you can find some opportunity in there, but just expect, as long as the overall market is volatile. When you have the S&P 500 getting dragged down the way it is right now, it's going to drag everything along with it. But that doesn't mean you can't find some opportunity right now.
Yeah, definitely. And I mean, I think, at least going back to Oracle's report, kind of reminds me a little bit. I mean, so when Target reported about a month ago, right, and we can look at Target's chart right here and see exactly when this report was. I mean, it was trading down like 24% the next day, which is just incredible for a company like Target, of its magnitude, of its size, and just the type of company it is, right? It's not some high growth tech company for it to see it trade down 25%. But when you went into the report, and like what the CEO was saying, the CEO was saying, we're still seeing a resilient consumer. We're still seeing like, high numbers of foot traffic. We haven't seen that drop off. We've just seen the consumption mix change. So instead of the types of goods that people were buying during COVID, right? TVs, cell phones, whatever it was, people were buying different things like suitcases for traveling, just buying different things, and Target's inventory wasn't equipped for that. So they said our margins aren't going to be as good, but we're still, and like that got kind of overlooked. The fact that he said they were still seeing a resilient consumer, kind of like how you're saying, Oracle is saying they're still seeing businesses spend money. They might just be spending money on different things.
Yeah, and I think it's looking, and to your point, you don't want to focus too much on, well, they're not buying TVs and stereos, whatever that might be. They're buying suitcases, which is an indication that people are getting out there and starting to travel again. But I think the bigger concern is, if it's so expensive for me to fill up my tank, so expensive for me to put food in the refrigerator, am I going to start going down to focusing my spending on those goods? So you could say, yeah, I'm still, instead of spending $500, 300 of it on food and gas, 200 of it on, a new TV that I really can't even tell the difference between the one I just, if I'm doing that, that is one thing. But if I'm now have to force to spend all 500 on gas and food, that is going to be a little bit more of a lower margin business. And you heard that from a lot of these retailers in the grocery space, at Kroger, for example, where people were looking at the shelf, and you could either buy the name brand soup, or you could buy the Kroger brand private label soup that's cheaper. People are buying the Kroger brand, and it's lower margin. So true, they're going in there and they're spending the same amount of money, but it may not be as profitable overall for these companies. I think it indicates a little bit more of a defensive consumer than one who's going out there and buying TVs for every room in the house, even though they don't need them, sort of a mentality.
Right. No, 100%. And that's why, like, I mean, at least, I don't know, I always try to be glass half full, like be optimistic. At least looking at the CPI that came out last Friday, I think we may even have talked about this, Shawn, that I was looking forward to it, thinking that it was going to be lower, and this could be one kind of potential bullish headline in this whirlwind of bearish headlines, saying, okay, at least with everything else going on, inflation has gone down 2 months in a row. Obviously, that didn't happen. But I was digging through the report, and there were some goods, including electronics, smartphones, TVs, and then some like house furniture stuff that actually dropped in price.
Mm-hmm.
I believe month over month, not year over year. But just that, okay, some of these like Target is coming out and saying we're gonna need to start slashing prices to get rid of some of this inventory. That's gonna result in some of these goods coming down. The question is, do the elevated gas prices, do the elevated travel costs, whether you're talking flight tickets, whatever, outweigh those prices dropping? I'm going to hope that at some point we see the gas prices, if not come down, at least just stop going up, so that when you get the deflation in these other places, that will be kind of translated in the final CPI report.
I think so. And I think that is the thing. Some of this is going to be a little bit painful. And I know, if you think about it, economics, they call it the dismal science. I don't necessarily think so. It's a little bit more of a, I think a pragmatic way is, look, there's a lot of stuff that maybe isn't selling as much. You just need to clear it out, rip off the Band-Aid, and then you can, sort of restock your inventory and your business model moving forward for something that's going to be a little bit more sustainable in the long run. You are going to experience some short-term pain. I think the Target example was extreme, because that was a big drop from and it wasn't some tiny company with a small float. That was a serious repricing that got a lot of people's attention. But you are probably going to have to see a lot of businesses ride out some volatility here for the next couple of months. And that might be what this year is used for, is just to sort of zero the clock a little bit for a lot of these businesses. It's going to drive some volatility. It's probably going to drive some downside price action, which we've already seen quite a bit of. But at some point, you will see this ultimate bottom come in, and that will be where people who are going in and being intelligent about deploying their capital, not trying to pick the exact bottom. Maybe if you're a trader, cutting down on your size, tightening up your stops a little bit. So things like that are one thing you do. But if you're a longer term investor, just slowly maintaining your standard monthly allocation to your 401k, your retirement accounts, or whatever it is you're doing, and maybe stepping it up a little bit in certain names, but not trying to go all in all at once. That's sort of, I think, the strategy for long-term investors and for traders that will drive the best results in the months to come.
Yeah, I 100% agree. Do you have anything else you're kind of seeing that's top of mind for you? Maybe if any like behaviors among retail investors has shifted at all, or anything along those lines?
I thought I am interested to see what the next IMX report comes out, our investor sentiment survey. So one thing is, there was, for the first time in quite a few months, net selling. They were actually net sellers notionally of equities last month, which it's proving out to be a little bit more prudent after this big, drop below that 3,900 level. I'm interested to see when they start to become net buyers again, and how strong of net buying that is. Is it just they slightly tick higher? They're still, sector to sector, they're net buyers and net sellers, or are we going to see some strong demand coming in where they're kind of net buyers across all major sectors, and also what the individual names that have high demand in? I think it's going to be interesting. I expect it to remain mostly focused on some of those big core names we're not worried about going anywhere. Microsoft, Apple, even some of the financials, JP Morgan. I think it'll be broad based, but within each sector, it'll be concentrated in sort of those more well established, sort of maturing type companies.
Yeah, and at least that's what we've seen on our end, is that there's been a lot more. I mean, especially compared to like last year during the COVID markets, there's been a lot more interest among retail investors in, things like ETFs, or things that are in general just more like conservative, safer investments, rather than trying to individually pick X high flying EV stock. I think a lot of people may have gotten burned like trying to do that, and then now they're like, yeah, I'll just invest in so and so ETF for the S&P 500.
Yeah, I think so. The idiosyncratic risk right now, from an execution standpoint, is about as elevated as I've really seen it. And it's one of those things where you can have one company target, hey, you know what, we overstocked on TVs and everything, we're going to have to clear this out. You could have, had another company in the same space who saw that coming and maybe didn't start restocking inventory at the same rate as Target. And it's kind of a little bit of a disappointment when you maybe get the overall macro trend correctly, but the company you pick didn't execute well. Even if they saw it coming, management didn't execute well on how they're managing inventory or whatever it might be. That is something that maybe will drive you away from wanting to go and try and find an individual company, and take more of a macro, just focus on your macro story and put that to work using indexes or ETF type trading strategies.
Yeah, no, I think so what I've always wanted to do to figure out just exactly how much it matters picking the individual stock versus just picking the right industry would be, so say you, Shawn, have a portfolio, I have a portfolio, and we each have 10 companies that are, paired. Like, I have UPS, you have FedEx. I have Coca-Cola, you have Pepsi. And so we each have a company in the same industry, but we just have the direct competitors, and then seeing, like, I feel like my hypothesis is that they will either be shockingly similar, that the returns will either be like, okay, you're up 15%, I'm up 14.5%, who cares? Or, all right, wow, you're up 30% and I'm down 5%. Wow, picking the right company within the sector actually really does matter. I have a feeling it would be on either side of the spectrum, but not in the middle. Like, it'll either be really important or very similar.
I think with the divergence we're seeing within sectors, I think it would actually be really important. And that is one thing, if you're looking at active managers who actively manage their funds, sure, they have something they benchmark to, but they do what you just said. I'm benchmarking to the S&P 500, but I'm going to go pick the top 2 energy names that I think are going to outperform the rest of the sector. I'm going to pick the top tech names, top financials. So they still allocate to the individual sectors like the S&P 500, but they actively pick the names within each sector. So say, look, I'm still going to put 5% of my portfolio to energy, but I'm not going with every energy company in the S&P 500. I'm going to pick the top 2 or 3, and that's who's getting my 5% energy allocation. I'll spread it across those 3 companies. There's actually metrics out there. I believe it's called the active ratio, if I'm not mistaken. But there's a metric out there where you actually can track the ability of these fund managers to select stocks. And that's how some of these fund managers become legendary, because they are proven over 20 years, all different market conditions, that they just outperform other asset managers from their active stock selection. There's not very many who have done it, but there are a handful out there who've really made a name for themselves doing that. It's the manager of the Magellan Fund for years, was known for doing that. They tried to put it through models and everything. Like, nope, he's just capturing alpha through his stock selection strategies. It was really interesting to see. But that there's a metric out there you can see as you see divergence within sectors though in performance. I actually would expect that that sort of a thing to really become more pronounced and a little bit more magnified.
Yeah, I might just do it for fun. I'm gonna create a watch list of like a fake portfolio of 10 companies and then pick 10 peers and see, you know, what the impact is over a year, say, if one is up a lot more than the other or vice versa. But yeah, Shawn, I don't know. Do you have anything else?
That's no. I'm actually interested in what's going on with the crypto space with some of these funds having to, the Coinbase news, funds over the weekend having to restrict activity to some degree or another. Crypto winters are something that I think have happened historically. I think crypto has never really been at the forefront of so many headlines in previous crypto winters. We certainly didn't have public companies out there, like Coinbase that were involved in there or Robinhood. So I think it's we're getting a little more insight into how crypto winters actually really affect the market now that there's a lot more eyes on it. But I am going to be interested to see sort of how that plays out for the crypto space in general, but then also some of the companies that are active in there as well.
Yeah, definitely. And I've been, I think I think crypto, I think Bitcoin is going to be around. It's here to stay. But I've been, I think, kind of critical of certain things in the industry over the past like few months or so. And I think especially with interest rates rising and a lot of this froth coming out of the market, like you see if we see some of these exchanges, say Celsius or just crypto projects, like completely dissipate and go to zero, I don't necessarily know if that's like a terrible thing for like maybe it was just necessary to kind of cut through some of that froth, and then we'll get to the real, like, where's the real value add? What's the real value add going to be here? Is it going to be just from Bitcoin? Is it going to be just from Coinbase? But my opinion has been that it's not. The value add from having cryptocurrency in our society isn't from having, so-and-so Shiba Inu coin popping up and going up 300%, and then, 90% of retail investors that invest in it lose their money. Like, that's not productive to me. So I think there is this, like you said, it's just has a bigger spotlight this time around. So I think there is a lot of skepticism and a lot of criticism going around, like, of the crypto community. So I think it will be really interesting to see long term where things shake out and where things fall.
Yeah, and I think business models are going to be important. We like to think of it all as this crypto company and that crypto company. I mean, kind of to your point of what you're saying, there's sort of differences in how everyone operates in this space, and even amongst what you think would be peers, there's still some differences in their operating models. And so I think one is there's probably a lot of people who are sitting back and watching this and getting to see, almost like some of these experiments, so to speak, play out in real time, in that all these different business models, you can see how they handle different levels of volatility out of the underlying assets. How they're going to respond to the regulatory environment, I think, is really the big thing this whole space is waiting on, is some rules before you get more players with, I think, a lot more assets, a lot more clients behind it going in there. But I think right now there's just a lot of people watching and seeing how the various business models and everything handle what's going on right now.
Yeah, I mean, exactly. I think, some of these business models, I know Sam Bankman-Fried, the guy who's founded and runs FTX, was on a podcast I was listening to, a Bloomberg podcast a couple months ago, and he was talking about the stablecoin industry and how that business model worked before Terra Luna or anything had broken. And he basically was like, yeah, it kind of is Ponzi-esque. Like, you need more people coming in for it to work. And he's like, but a lot of these companies are making a lot of money doing it. Like, he was just very upfront about, kind of unveiling that, kind of curtain, and then showing the business model behind some of these projects, where that's why I think, and sure, that worked in an environment where interest rates were at zero and there was free money just flowing around the ecosystem. But if that changes, then maybe these things aren't going to work as well.
Yeah, I mean, when we talked earlier about risk capital and some frothier areas of the equity market, I would think of, cryptocurrencies right now as sort of the riskiest of the risk assets. So as that pool of risk capital shrinks, I think that it makes sense. That would probably be the first place to really start to feel it. And it kind of did earlier this year, even before that, when you think of some of the levels and everything that Bitcoin pulled back from. It was one of the areas that really, I think, experienced that risk capital pool drying up a little bit, first off.
Yeah. And I think a lot of people in like traditional finance and stuff are excited to see that happen, to see some of that, froth dry up and some of these things kind of revert back to normal. But obviously, just because some of those people want to see that doesn't mean that we all do.
No. And I always, that's like a pet peeve of mine. People are like rooting against something to fail or go down. I'm like, look, it's an interesting space. I do think there's going to be, and I think there's like a spectrum of people and what they see as the future of cryptocurrencies or anything on the blockchain. And there's people that sort of fall on this is going to be the come all be all, going to replace every single system as we know it. They're in an institution, or there's some people who think it's going to go to zero, and then there's some people in the middle who think it's going to change up and make things a lot more efficient in a lot of areas. I'm probably closer to the middle on that. But I do think it's going to be interesting to see, like I said, as we get some of, this froth getting wiped out right now, some business models getting proven out, some of the coins maybe having some sort of a use case in terms of really what's behind them. I think it's going to be interesting to see sort of what comes out of the shakeup we're getting right now.
100%. And I 100% agree, Shawn, where I'm kind of in the middle, where I hear some people. I think one of the things that like kind of turned me off about crypto a little bit was some of the people that are like huge proponents of it saying, oh, it's going to change the world in this way and that way. Like, we all got to buy this and we're all going to get rich. Where it's just like, all right, first of all, if something sounds too good to be true, right? We can't all go buy Dogecoin and all get rich. Like, that's not how these things work. Second of all, I'm going to need to hear the explanation on how this is going to change the world and is actually good for the environment, like all these things. And then on the flip side, I see people that are, either not in crypto or they're against it or whatever, where they'll post things on Twitter where they're like laughing about some guy who is, got basically rug pulled or like hacked and is, some like everyday worker who's lost a lot of money. It's like, that's not funny to me. Like that, I hate seeing that, but like people being like, oh, look at these crypto bros like taking L's, they're so stupid. It's like, come on, like we don't need that. So I'm very much in the middle on that as well.
Yeah, I am interested to see, like I said, what sort of regulatory guidance and environment comes out when we finally do get something, as far as just rules of the game. I think that'll pull a lot more people in. I think there's a significant amount of people on the sideline waiting for that to happen. And I think right now what you're seeing in terms of what's working, what isn't, is probably going to be used to evaluate where the new players coming in, when they eventually do, where that money actually flows and maybe where it shies away from.
Yep, 100% agreed. Excuse me. All right, Shawn, always great to get you on. Enjoy the rest of your day. Looking forward to chatting with you next week.
Yep, have a good one.
You too. Bye-bye. All right, guys, that was Shawn Cruz from TD Ameritrade and Schwab. Always great to get Shawn on, share some of his thoughts on the market. Like I said earlier, markets are moving, and so are we. We do have our next guest, Christian Fromhertz from Tribeca Trade Group, hanging out backstage. Let's go ahead and get ready to bring him on. Before we do, I'll just do a quick run through of the overall markets. The S&P 500 is now down a little bit less than 0.5%. I'm seeing around 0.4% right now, which in the red, but I mean, after yesterday, shoot, I'll take this all day long compared to yesterday. We're doing about 10 times better than we were doing yesterday at this time. Check in on the Qs. Qs are actually still in the green, albeit very flat, up less than 0.1%, 0.08% is what I'm seeing right now. So tech a little bit stronger than your than the SPY today. Qs are holding up, but nothing really to write home about or be excited about. The Dow Industrial Average down 6.5%. Sorry, not 6.5%. 0.65%, 0.6%. So Dow is actually your laggard on the day so far out of the major indices. Interesting to see. And then you got Bitcoin. Bitcoin's hanging out above $22,000, $22,600 right now. Up 2% on the day is what my Robinhood's telling me. I believe that's from like midnight Eastern. So from midnight Eastern, we are up more than 2% on Bitcoin. Something to get excited about potentially. Ethereum up 5% from that midnight Eastern time. Ethereum above $1,200. But all right, enough of me blabbering. Let's go ahead and bring on Christian Fromhertz, our next guest, who will be joining us, maybe from Tribeca. I'm not quite sure. I think we've asked him before and I forgot. But either way, let's get him on the show. Mr. Fromhertz, how are you doing today? Oh, I think we got you on mute.
There we go. Sorry about that. I was on mute. How you doing, Aaron?
I'm good. I'm hanging in there. I mean, the markets are doing what they're doing. Trying to not let it get me down.
Yeah, I mean, I think it's one of those days, and it's a very choppy day that we have right now in the indices. But just as you went through the performance and so forth, I mean, there's a lot of interesting moves going on, and it is kind of rough, if you are more of a market bull, watching this price action the last couple days. But go back to like the P word, having patience right now in this market, that's paramount if you are looking for opportunities on the long side. It's one of those things where there's so many different things that are going on right now, and I can certainly chat about a couple of those things that I'm watching today. But I think what you've got going on right now is really interesting, and I think if you can kind of postpone that immediate gratification, in terms of positioning right now for big trades or anything like that in the short term, I think that this is kind of getting to the point where things are starting to get a bit washed out in the short term, and of course we've got a Fed meeting tomorrow, and the Fed is going the other way of the market right now. But if you kind of look at past this, maybe a little bit past the summer, you may be getting some good buying opportunities coming, and again, the patience is of course the key there. But I think that's going to materialize at some point.
Yeah, and it's so interesting now. I was just showing a few minutes ago with my previous guest the CME watch tool, which shows us that in one day, I don't know if I've ever seen this, where in one day we've completely, so yesterday, this tool, which just rates the probability of like where the rate hike is going to be, yesterday was giving us a 65% chance that we were going to see a 50 basis point hike, and today
Right.
that percentage has dropped down to 3. So now we're 97% sure that we're going to see that 75 point hike. My question is now, if this is the expectation, this is the sentiment across the market, the 75 point hike you would have to imagine is getting priced in. Maybe that's a little bit of what was happening yesterday when we finished with the NASDAQ down like 5% or whatever. But is there is there a potential that when we get that 75% confirmation of it, that there's not even a drop like from there because it's what people are expecting anyway?
Yeah, I think you're hitting the nail on the head in terms of we always want to think about expectations with market, like what is the market pricing in, and what you were just looking at is what Fed fund futures are currently pricing in, and a difference a day makes. Right, the market was not pricing in 75 basis points yesterday. That's part of what we're seeing.
At least in the morning. At least in the morning. Maybe by the afternoon.
Yeah, I mean, and even this, I was looking at the same data point this morning, and I think it was at 90% or 92% for a 75 basis hike. So the market is adjusting to this, and it's adjusting to it in real time. Clearly the volatility, and it's not like nothing's happening. The market's been selling off, getting used to that. So it's a process when they change expectation. When they make a change like that, the markets aren't just going to sit there, and they are adjusting to that, but they're starting to really kind of price in a lot of that, the bad news, again, it's not like nothing's happening. The market's going down with that, and we're seeing like just various different areas of the market that are really getting hit hard, and there are a lot of moving parts this week. You're looking at quadruple witching coming on Friday, so this is one of those where I think that there could be a squeeze coming tomorrow because I think that they're pricing it in, and it's to the point now where if Powell ends up saying anything dovish, and even to the effect of something like, "Hey, we're going to do 75 basis points," I think really the key, what will be important to listen to in the press conference is what he's like. Is he going to do another 75? Is that what he's looking at, or is he going to go back to the 50 basis points, and we're going to kind of see how this inflation comes out in the next months, because they don't have a crystal ball. Like, they want to see too, like, how this goes along month to month. So I think if he comes out and says 75 basis points tomorrow, right? If he's if they do 75 basis points tomorrow and they talk about doing another 75 basis points, I mean, he could be getting closer to actually having to walk that back, right? If you're thinking at some point that there's going to be a Fed pivot, right? I think we were just looking at what it's pricing in for tomorrow. But when you start to look at 2023 and 2024, Fed fund futures are also starting to price in rate cuts, the possibility of rate cuts.
Yeah, in like 2023, and that's you got to assume that's like, okay, we're in a recession now, we got to cut rate. It's like, oh my god, like there's just so much, I feel like, unknown and information that we're getting, that it makes it like almost impossible to make informed decisions right now, because like it's on one hand you're getting these things that are signaling, okay, we're for sure heading to a recession, and on the other hand you're getting things that are like, oh no, the economy actually, it might not be doing 100% amazing, but it's okay. It's not like if you think back to 08, 09, you had something that had to fundamentally break to get to that point, right? And you had to a point where you had to have banks being bailed out, the auto manufacturers. I don't know if there's something out there, going to break like that. Because I mean, if you take like the housing market, for example, even with rates rising and now mortgage rates are rising, and certainly pricing some people out that were maybe borderline on the fence going to buy a house, and now they can't afford it with the rising mortgage rates, there's still a shortage of houses. Like, the demand is still outweighing the supply. So for there would have to be something, again, to really fundamentally break to get that type of crash and recession that it seems like some people are calling for.
Well, I think things are, like we said, things are happening very quickly, real time. I mean, even if you look at the long, of course, so when you were just looking at Fed fund futures, that's the short end of the curve, right? And sometimes that gets confusing to investors when they hear interest rate cuts or hikes, right? That's the short end of the curve. That's the overnight rate. But, I keep posting on Twitter, like, what's going on with the long bond, and we can kind of look at that chart too. I can share my screen in a minute, but
yeah, and I did just get your email. You're more than welcome to share whatever chart.
Okay, good. Okay, let me do the old share screen, which takes me a minute all the time because I got to figure out where that button is. Share screen. Okay, they're giving me tips to follow. I don't need the tips to follow. So of course this is S&P, but if you look, so what I find very interesting is, because I don't know if I've ever seen this happen the same exact way, because this is the chart of the long bonds, right? This is the 30-year bond futures, and when you compare this with the S&P, they're both getting hit really hard at the same time, and I do think, like, first of all, like the bonds have to stop going down like this, right? Because again, we're looking at price, and if the way a bond works is, of course, it's inverted with yields. So the more this goes down, the more, the higher the interest rates are going down. Higher the interest rates are going up. So that's already like bringing a tightening to what's going on in the market, right?
I mean, Christian, I was literally saying the same exact thing earlier on the show, where it's like you have all these people like saying, "Oh, recession's for sure," and it's like, look at the bond market. The bond market's not saying that. I mean, people, if there was for sure a recession and people didn't want to be in equities at all, the bond market wouldn't be doing what it's doing. And there's also
then you do have to look at what's going on with the overall. So good point. But I think you have to also look at the shape of the curve, right? And when it does get inverted, right? So if the 2-year spread is going up faster than the 30. Then I think they look at 2 and 10s, right? Then that does flash the recession warning. So
that's essentially showing that people are expecting the next 2 years of the economy to not be good, but maybe they don't want to be locked up in the 10-year bonds.
Yeah, I mean, so the inversion of the yield curve is what usually signals recession, and right now it's borderline like triggering whether or not that's what we're getting. But um, at the same point, like I saw a couple headlines earlier, a couple companies like Redfin, they're announcing, besides outside of the cryptos, which I heard you guys talking about just a moment ago, but outside of the crypto space, because Coinbase just announced layoffs today. We're starting to hear it in the real estate market too. So, like Redfin just made some announcements. So like Powell's going to be, the Fed is going to be listening to that too. They've got to try to, thread the needle. Which there's been a lot of criticism about, how they're inaction, right? And we've seen this before. We saw this before with Janet Yellen. For a while with her meetings, and I'm not criticizing but I'm not trying to criticize them, but it just is what it is. They postponed raising interest rates, and then by the time that they decided to do it, it was too late, to an extent. So it's the same thing, that's going on, and so it will be the question. And again, it's not something that I think is going to happen today, tomorrow, even though we've got a Fed meeting tomorrow. But I think, it's the middle of June, which is also a very seasonal weak time of the year. I think if you can kind of just think about your time horizon, what we're going to get once we get to the fall, could it be that the Feds could, pivot at that point, right? And then I think at that point, you're going to see, probably some other things that might get interesting, in terms of where prices have gotten to. So I think, again, patience is the key word. The volatility, even with sectors, like if you're, and again, this week is quadruple witching. The S&P and the NASDAQ rebalance their indices on Friday. But I mean, look at what's going on with utilities and consumer staples today. So, I mean, this is just a very difficult market. The cash right now is the place to be in. And the way that I kind of switch my trading to a little bit when we see these types of moves is just doing more day trading. I'm a swing trader. I don't like shorting things at this point. I don't like shorting in the hole for this much, but there could definitely be some more opportunities. To talk about the short side today, like Airbnb is seeing puts today. All the travel stocks, I don't know if you've been paying attention to like what's been going on with like a CCL, Carnival.
Well, I haven't been watching the cruise lines that much. I've been watching the airlines a lot. And like last week, even, I mean, I think I think yesterday, like a lot of the airlines are getting hammered, and it's like, I don't know. I don't know. Obviously, like there are analysts out there and stuff that are studying these airlines and know the companies better than I do. But from what I can see, like the prices of plane tickets are so high. And when I've traveled in the past month or so, like the flights have been pretty busy, that it seems like these companies are able to pass off a lot of their added production costs to customers. But I guess we won't know that for sure until their next earnings report. Have they been able to pass off some of these? Because the bottom line, look, jet fuel is more expensive, so it's going to cost the companies more money to do their flights. The airline companies are not immune to having labor short. They've had to cancel a lot of flights, pilot shortage, whatever. But it would just be a shock to me that if these companies don't report like decent earnings with the the plane tickets where they're at. Like you're telling me it's $500 for me to go fly round trip from Detroit to St. Louis right now, and somehow Southwest Airlines is going to take that money and they're not making money. Like it doesn't compute to me. But again, I'm not watching these airlines and understanding their business model as well as some people are.
Right. Well, I mean, I think it's going to be, we both witnessed what we saw going to Vegas just about a month ago, and everything was jam packed. The airport was jam packed, and the prices were insane. And I think it was either last week or the week before, the JetBlue CEO made comments saying that he's never seen demand like this. However, things could drop off pretty quickly, and I think that's what you're kind of seeing priced into some of these stock prices. And it, when we went to Vegas, and I had another experience where I was trying to rent a car about a month before that, and the line was just insane. And I looked at the stock price of Avis, because I'm a preferred member of Avis, but it just wasn't, the chart wasn't jumping out to me then, and I think I missed a little bit of a move. But I think in these airlines, it's, so I agree. I think they're going to report like very good earnings, but it always goes down to the guidance. Like, are they going to see, you know, is what the Fed is doing, and interest rates and everything else going on, like in the present day, is that going to change very quickly with, how quickly the Fed is starting to move and so forth. So that's what I'm watching. Yeah.
Yeah, that makes sense. Just people saying like, okay, the airlines might be doing well and selling expensive tickets right now, but as gas prices rise, people won't be able to afford to take their flight, whatever. So the prices aren't doing that well in stocks. That makes sense.
Right. And
Christian,
yeah.
Sorry. Go ahead.
No, go for it. Sorry.
I was just gonna say we got to run here in a second. So if you got any final thoughts or things top of your mind.
Yes, I do. It was great. It was great chatting with you. But one group that I think, so this was one of the first groups to kind of get hit, right? So what I'm looking at is the Chinese internet ETF with the U.S. internet ETF. I like what's going on here. This group has been a dog for a while, but and I think I talked about this recently. Possibly on your show. But I just like what's going on with several of these names, and you can kind of pick through. Like, I'm long a little bit of PDD. I'm looking for this PDD to get over the 200-day moving average. But this is what you want to see after, decent downtrends. I'm even long a little bit of this IQ, which after a huge decline has been basing now for 6 months. So again, I got to see it get above the 200-day moving average. But these things look like they're in the process of bottoming, and I'm not saying it's completely in yet, in terms of the bottom is in, but I think really, you want to be closely watching some of these Chinese internet names, because they are showing some relative strength, especially versus the U.S. group, and they're in a different cycle. They're not tightening like the U.S. is.
Yeah, I mean, I've been watching more of the individual names. Baba, particularly, I was kind of kicking myself because yesterday Baba was down like 10% while the overall market was getting hammered. And I was like, this is a stock that's been pretty strong. It's in an uptrend and it's down 10%. And I was like, literally, like on my brokerage, like buying calls. And then I just like didn't do it. I was like, you know what? I'll just wait. This environment, like, it's not worth it buying. And they were just YOLO calls that expired this Friday. Of course, it's up like 7% today, and I would have made 100%. But, neither here nor there.
Yeah, I mean, exactly. Just like anything else, it's tough because once they start moving, you're like, oh, geez, maybe this is really, just like I said, maybe they're putting the bottom in. But I think, as long as you're kind of just realizing that we're in a volatile environment, so like starter positions help with the background in your mind that you're going to add on a dip, as long as it holds, where it's kind of carving out that support. And like same thing with an XPEV, it's still kind of, this isn't a downtrend, but I just like that the price action today, it's up 8% today, where, there's other things that are getting killed right now in this market. So I think it's, number one, relative strength, but I'm really going to be watching this group in the coming weeks and starting to kind of put in some more swing trades if it continues to show constructive price action.
Beautiful. Well, I'm excited to get you back on next week to talk about some of these trades, some of these setups. Christian, I'll follow up with you on email after, but thanks for hopping on the show today.
Awesome. Always. Have a great day, guys.
You do the same. All right, guys, that was Christian from Tribeca Trade Group. I will add that link in the chat in a second. God, I freaking love this. Market Fiend TV. Massive short squeeze at 2:15 p.m. Eastern tomorrow. Look, if you're going to make some like bold, outlandish predictions about the market, do it like Market Fiend did. Tell me exactly what time you think this thing is going to happen at. No one knows. We have no clue. If we see a massive short squeeze though tomorrow at 2:15 Market Fiend, I will be following your next calls for the next like month at least. So again, I love that. I love the boldness in that claim. All right, y'all. Let's keep it ticking. Let's keep it moving. I've got Dave Mazza hanging out backstage, the head of product at Direxion. We're going to talk about some ETFs. Who knows? I mean, we were just talking about K-Web with Mr. Fromhertz. Maybe we can keep that China discussion ongoing with Mr. Mazza, and we can discuss their yin and yang ETFs. But without further ado, let's go ahead and play our special intro and get David on the show. Hey, Dave, how's it going?
It's going well. How are you?
Pretty good. Cannot complain. So I don't know if you were listening to our last conversation, but we were talking about China a little bit, and that gave me the thought, hey, this could be a good lead-in, good segue to Mr. Mazza. We can do the yin and yang real quick.
Yeah, exactly. So yin and yang, they are 3x bull and bear ETFs for the Chinese equity market. And so again, for anyone new to this, bull and bear means leverage and inverse in direction terms, and they offer amplified exposure to the daily returns of an underlying index. In this case, Chinese stocks. And yeah, what we've seen is some kind of interesting action in yin and yang over the last couple of weeks, as now people are, I think, getting comfortable stepping back in. You look at that big uptick in volume here. Particularly, on the yin side over the last couple of weeks, if not, and that's probably consistent with people's expectations. We'll get some bottom fishing again, people looking to step back in.
Yeah. So, I mean, I'm just looking at the yin chart right here. And like you said, I mean, this was just a couple days ago. Looks like we had this huge volume increase. Looks like volume on this day on I'm looking at the weekly chart. So volume over this week on week ending May 30th, 2022, the volume was almost 20 million. You compare that to the next week was less than 10. So it looks like there was a lot of volume coming in to this yen. This is the bullish one a couple weeks ago.
Yeah, exactly. So people we're looking at the bullish exposure right around the Memorial Day holiday. And in particular, when we saw that, obviously Chinese stocks, really getting hurt, but we've begun to see a bit of improvement there. Obviously questions about continued lockdowns in Shanghai, Beijing, other major cities. It's a potential pushback on that as they go about their COVID-0 policy. But we have seen traders step back into the space as some of the potential regulatory issues on Chinese internet stocks have come off, maybe some potential greater clarity there of what authorities might be doing from easing monetary policy. So on that basically following that huge up day that we saw, I think it was Wednesday, the 1st of June, huge uptick in volume happening correspondingly. And it stayed pretty strong over the last couple of weeks as well.
Wow. Yeah. And I think too, I mean, like you said, like there's just a lot of uncertainty in China and how they're going to do, how they're going to regulate, if they're going to abandon their zero COVID policy. Are we going to see more COVID lockdowns? But I do think, and this is by no means investment advice or anything, I do think, these people coming in, buying the dip essentially on the yin, there could be, and I mean, look, we're on the weekly charts. If we zoom out, we've gotten so beaten up on a lot of these China names, and we can go to individual names like Baba I was mentioning earlier, that by buying down here, you're essentially taking on that risk in saying that you don't think that China is going to, continue to crack down even harder on its big business than it has already. And from my perspective, my thinking is China, like they want to be the overtake us as the world's largest economy. Like they know the way in doing so, or to do so, they can't continue cracking down. Like I'm just betting long term that our trade relationship will essentially remain unchanged with China. Not that we're going to see some huge falling out that changes forever how we do business with China.
Yeah, look, I think there's probably some truth to that. Obviously, there's some rumors of what might be happening with the Biden administration, potentially rolling back some of those Trump era tariffs, which may actually at this point be more beneficial to the U.S. economy. But you're absolutely right. Is that at the end of the day, there's a mutually beneficial relationship, setting aside politics for both economies. And what we're seeing is, Federal Reserve tomorrow might be putting a massive hike as our economy is slowing China, economy actually might be again leading the U.S. as they begin to recover a bit more from the major crackdowns on COVID that they had in the last couple of months, which we haven't really been experiencing. So I do think for traders who are looking to step back in, particularly coming to those Chinese tech names, that might be the area to bottom fish. And, look, that's not a fundamental thesis. I'm just looking at what the data is telling us. And certainly we're seeing the activity happen first and foremost in China. And not, and other than semiconductors, which at this point I'm a broken record where we continue to see people buying the SOXL dip, that's really been one of the only bright spots we've seen traders come back in the Direxion lineup.
Yeah, I mean, we talked about this last week, how like I was curious when you guys kind of put out these semiconductor SOXL and SOXX, if you guys ever thought like they would, or no, sorry, SOXX isn't. What's the SOXS? Is that the
That's the bear, XOXS.
XOS, you have SOXS and SOXL. Wow, it's a mouthful. But just that, like you maybe you didn't know at the time that like this would eventually become your far and away like biggest ETF, get the most volume, was people just wanting to trade either on the bullish or bearish side. The crazy movements in the semiconductor names.
Yeah, no, you're absolutely right. I think most historically, most of the assets that are in our trading vehicles were on your S&P 500, Russell 2000. But that's not the case anymore. As people are comfortable, particularly traders, have become more comfortable with narrower exposures. And sometimes you think narrow in the market, maybe that's not a good thing. Well, in this case, it can be, because if someone wants to pinpoint that exposure just to semis, you can do that with SOXL. And look, on these, and that chart is a pretty ugly performance chart, but the volume's still there. And in particular, in the last week, we saw a lot of inflows into this fund as people have tried to kind of, again, call this bottom. Hasn't necessarily worked. It may not continue to work, but we're continuing to see people look to trade it. The other thing which I'll note that we look at here is the implied holding period. And what does that mouthful sound like? Well, really all that does is measure the turnover. So how much activity is happening in the fund. And it stayed very, very low. In fact, it's shortened with SOXL. So people are coming in, but trading it, moving in and out quickly. I can't tell you if they're making money or not, but I can tell you that they are trading the fund to a much greater extent than they have had historically.
Yeah, and so this is SOXL, the 3 times bullish fund on the semiconductor industry. And you mentioned the chart doesn't look great, but I'll just take the time to mention that it is a inverse 3 times, leveraged ETF. So as kind of we got some downturns in the bigger semiconductor names, AMD, NVIDIA, you name it, that downward action is going to be kind of more prominent on this chart, really. So, but you can see here, I mean, like this is just incredible. And we're on weekly candles, but the volume down here, I mean, 367 million shares of this ETF traded in 1 week at the beginning of May. And you can see as the price is coming down in this, that volume increasing. So, yeah, just showing that more and more people are coming in and buying this. And it sounds like even with the downtrend, people want to be long this space and not, selling it down here.
Yeah, correct. And this might be counterintuitive to some folks. And I think this is where there's some confusion about how people actually use leverage and inverse ETFs, is that we actually think that that's a good thing, meaning that's healthy behavior. If you're trying to trade it, that's how they're supposed to be used. These are not buy and hold investment vehicles. The super long-term chart we know, looks terrific, but the sell-off has been unbelievable because these are not buy and hold investment vehicles. So when I see volume increase in downdrafts, to me that's a good thing, and I would say the same on the inverse side, right? So if someone's looking, trading volume has increased there, but we're continuing to see again more people trying to buy to time this dip and trade this dip.
Yeah, and 100% just seeing that kind of healthy trading behavior. Because if I would look at this chart and see that like the volume was the highest right here and we were at all-time highs, that would probably look a lot like what the volume chart on something like Dogecoin would look at, right? Where it's like at the all-time high, people, the most hype is about it. You get all this FOMO buying, and people, the most buying is when it's at the top. That's not really what you want to see with some of these vehicles, like you mentioned, are for more active trading, where you see the volume. Look at this back here too with the COVID crash. People were loading up on this, or there was a lot of volume at least, right down here when we dropped down to like $5 on this fund, and then it went all the way from 5 to 70. And now we're seeing that volume increase again as we get. I mean, this is kind of incredible that we're now at, we're lower than we were pre-COVID crash. We're at 1567 on here, and so I mean, it seems like an incredible buying opportunity down here for a lot of people.
Yeah, we're taking on a lot of the gains that we've had. And, again, from a fundamental point of view, you can maybe argue that these names got well ahead of their valuations, even though their earnings growth was remarkable. But, the way you make a great point is I would, if we were seeing so much activity kind of buying that momentum, that would give me caution and say, hey, we got to really continue to educate, direct people to our quizzes on Direxion.com to understand how to use these products. But if we're seeing that on these down days, on these pullbacks, to me, that's why we continue to tell the story about how to actually appropriately use these tools as your trading vehicles.
100%. Dave, is there anything else kind of top of mind for you? Things that you've been watching, things you've been looking at that you'd like to discuss today?
The only other thing I'll note is one other ticker, Gush. So this is an oil and gas 2x bull fund. And yeah, we can see, that this fund has had really strong performance. Got smoked, of course, yesterday as the entire space. There was nowhere to hide, even energy, which has been a bright spot. Volume hasn't really been too remarkable here, which again might be a good thing, because as this fund has really ripped higher, people are not necessarily buying and holding it, which we advocate against. So. Really interesting. The bear fund is drip, as you're now showing now. That's where we're actually seeing people say, hey, maybe that this near-term sell-off got overextended. So yeah, your pointer is in exactly the right spot. So
right.
Interesting activity.
When you said that there hasn't really been incredible volume in Gush, it made me think, well, I wonder if people are going to buy drip instead, which, yeah, I mean, it looks like, going back to the Gush chart, like you said, the volume hasn't been insane or anything. It looks like, if we zoom out a little bit, that there was some higher volume back here. But again, like that's good to me that you've seen. All right, let's look right here on like a monthly candle. And I gotta zoom in because with these leveraged ETFs, you get these like reverse splits and stuff. But I mean, this was up 33% in 1 month, and look at the volume; it's lower. You wouldn't want people loading in on this while it's up 33% in a month. That's not good trading behavior.
Correct, exactly, because it's we would all love to have that hindsight to predict that, but likely when you see such high returns, whether the trend is still there, you're going to see some sort of a pullback on that kind of a nearer term trade basis. So you're spot on.
Right, and you just got to always think about, like, you got to imagine, right, if you're getting into a trade that's been up 25% over the last month, you got to think about the people that bought in on that before they got in, and now they're looking at their thing up 25%. Oh, it's time to trim some. It's time to sell some. They're not buying
Correct.
with you. They're selling to you.
Spot on. Exactly.
All right, Dave. The last thing I was going to ask about was this DFEN. I mean, I assume there was some added interest in this defense ETF during, when we were talking more about the Russia-Ukraine invasion. It seems like as the media is kind of, we've not been talking about it as much. Have you seen a drop off in traffic here?
Yeah, exactly. Still an interesting space is your aerospace and defense stocks. Yeah, I mean, unfortunately, as this war has become prolonged over 100 days, it's not top of mind. Although there's still a lot of human suffering and issues there, and because of that, and frankly, probably because of the nightly news has now moved to inflation and potential concerns about economic growth, crypto issues, what have you. We haven't really seen traders gravitate toward defend, but this is a space that I would recommend anyone who's interested in trading these products kind of keep on their radar, because when this thing moves, it can move very quickly, both to the upside and the downside.
Yeah, and we definitely saw a lot of action and volume in these defense names when that was ongoing. And that, like, my background is more in media, more in journalism, and I think I said that to Spencer when he was still here. I was like, watch, in 2 weeks, this isn't even going to be on CNN anymore. And he's like, you're crazy. Like, this is the biggest story, whatever. Then sure enough, 2 weeks comes. I'm looking at CNN right now. They're talking about January 6th. They're not talking about, a war where like actual people are suffering. So it's all about, whether it's inflation, January 6th, whatever it is. It's like, what can we talk about to either, scare people or just keep people's attention? It's not really, always, I don't know. I mean, I could go on all day about how the cable news, aren't doing a great job, but that's neither here nor there. All right, Dave. Well, I appreciate you coming on the show today. If you don't have anything else, we're about to wrap up the show, and then looking forward to getting you back on next week.
Cool. We'll talk soon.
All right, Dave. Enjoy the rest of your day.
You too. Bye.
All right, y'all. That was Dave Mazza, head of product with Direxion. Go check out their ETFs. All right, y'all. I got to wrap. We're running late. Ran 5 minutes late. 10 minutes late, really. Money Mitch is about to start up. New time slot. This is automatically set to redirect you to Mitch. So just stay tuned. Don't go anywhere. And Mitch will take care of y'all the way he does.